Thank you to everyone for connecting to this webinar. And well, I think you are now seeing my presentation, right? Yeah. Okay, so the title of my presentation today is Bank Market Power and Firm Finance, Evidence from Bank, Firm, and Loan Level Data. This is a project that started as an initiative of the Inter-American Development Bank, in which several countries are participating: Brazil, Chile, Mexico, Colombia, the US, and the UK. And the advisor to this research project is Professor Thorsten Beck, who works in the United Kingdom, in England. And the idea, the general idea of the paper that I'm going to present you is the interest that is based on the high interest rate spreads that is observed in many developing countries that has concerned economists and policymakers for a long time. And this has been particularly true in Latin America. So in Latin America, Brazil and Colombia are probably the two countries of the world, or two of the countries of the world with the highest interest rate spreads. In a study that I did some years ago with Adolfo Meisel, who is now the president of the Universidad del Norte, a university in Colombia, and at the time when we did the study, he was member of the Board of Governors of the Central Bank of Colombia. We found that Colombia and Brazil have really huge interest rate spreads. And the question is, why so high spreads? And this question is not only of interest for academics, but also for policymakers, and it's also of interest for the general public. And different hypotheses are observed in the literature and sometimes are responded by members of the banks and sometimes by other sectors, but by policymakers. And one possibility is limited enforcement of contracts. So it's common knowledge that in Latin America and many other developing countries, the enforcement of contracts is not full. So it is sometimes limited liability, and those things can create problems. And other things that are sometimes accused of explaining these very high interest rate spreads observed in the region is the existence of scale economies in the banking sector. And in developing countries, for example, Colombia is a middle-income country in which many loans are of low denomination. So sometimes if loans have a low denomination, well, the costs of administrating those loans is high. So due to economies of scale, it'd be like rather natural to observe these high interest rate spreads. That's another hypothesis. There are also another hypothesis, for example, from the excess risk that comes from volatile industries. So for example given commodity producers. Colombia has many firms that work in the oil sector, and other commodity are also commodity producers of other commodities, and many countries like Mexico and Brazil too. So sometimes the high risk that the volatility of these sectors may imply makes also loans riskier. Than this might explain these very high interest rate spreads in the region. However, what about competition? What about banking competition? Does it matter? It may matter. It may be one of the factors explaining these high interest rate spreads. Some studies say it might matter, and it might matter importantly. So the question that we have two basic questions that we want to answer in this research, and I'm going to go over them with more detail further in the presentation. But basically is how to measure in a good way banking competition in Colombia, and how to check how does bank competition and firm access to credit interact. So basically, if we focus only in the second question, in the way in which bank competition and firm access to credit interact, there are two competing theories. There's the classical industrial economics explanation, that's the rent extraction theory, that will say that if banks have a high market power, then they will extract rents due to monopolistic power to the debtors, and then this will explain the high interest rates, the high interest spreads that we observed in credit markets. But there's a second hypothesis that it's rather newer than the traditional industrial economics hypothesis. That's the information hypothesis that probably many of you are related with. But this says that basically to build a good stock of information, it's very costly for banks due to informational asymmetry. So the banking sector is different from many other industries in the world in the sense that information asymmetries abound in the banking industry. And due to those information asymmetries and that the creditor doesn't know the quality of the debtor when it's extending the debt contract, then it has to proxy that his or her behavior in the credit market with imperfect measures of his or her commitment to repay. So acquiring that information is costly. And if banks have some market power, then they have the ability to invest in these very expensive information technologies that will allow them to acquire good information and to know to which extent which observables are good proxies of the repayment behavior of debtors. And then good debtors will benefit from lower interest rates because they will pay the fair price that they should pay for their loans, and bad debtors will pay a terribly large price, or probably they will be excluded from the market because they are bad debtors. And this is just an application of the paradigm of economics information that started with Akerlof and the Lemons paper in the 1970s. So we want to study empirically which of those theories regarding the relation between banks and access to credit by firms prevails. So I'm going to go briefly through an introduction in which I'm going to try to motivate why it's important to study this topic in the context of developing countries and especially in Colombia. Later, I'm going to make a really brief comment about the recent evolution of the banking industry in my country, in Colombia. Then I'm going to go more specifically into the two questions that I'm trying to answer with my two. I'm sorry, I forgot to mention that in this paper is in co-authorship with two good friends, with Cesar Tamayo, who is now the Dean of the School of Economics and Finance at Universidad de AFID, and Oscar Valencia, who is a senior economist from the Inter-American Development Bank. Well, and then I'm going to go through the point that we're studying with my two colleagues, the point of how to measure bank market power in Colombia and what conclusions can we extract from these measures. And finally, I'm going to go through the relation between market power and the cost of firm finance. I want to let you know that this is work in progress, so all your comments and all your questions are very welcome. We are working in refining the methods that we use here and refining the results that we have found. We sent this paper to the Journal of Banking and Finance, and we received a revise and resubmit request by the Journal of Banking and Finance. So we are now working in improving our paper for the second round of review. So all comments are very welcome, and questions also. So regarding the introduction and motivation, why is it important to study this topic in Colombia and in Latin America in general? Credit markets in Latin America and Colombia are really shallow. And in this first graph, you see the ratio of private credit extended by banks to GDP in different types of countries. So you can see that high-income countries, as it's widely known, they have a very profound, very deep financial markets. And even though most of these high-income countries are market-based rather than bank-based, even though that they have very deep, profound, well-built banking systems in which private credit flows very well. And the ratio of private credit by banks to GDP is around 87%. So it's huge, more than double that ratio for upper middle income countries. If you then go to the left of the distribution, you see that Latin American countries have a very modest ratio of private credit by banks to GDP of only 35%, and Colombia is even below that average. So as you know, Colombia entered fully to the OECD as the 37th country earlier this year. So we should be comparing with at least upper middle income countries. We should have credit markets in which credit flows well to the private sector. This will have a lot of benefits for the development of firms, for the reduction of informality that abound in the Latin American employment markets. But Colombia is well below even the average of Latin America. So this is something that's very interesting. Colombia is kind of a special country in the region and a special country among the upper middle income countries in this very low deepness or this fact that the credit market is shallow in Colombia. As maybe many of you know, but I don't really know who I have in front in this webinar, so I would say it because probably for you this is also some piece of information that's new for you. Colombia has almost inexistent capital markets. So the only well-developed capital markets in Colombia is that of public debt. But private debt in Colombia, the markets are extremely shallow. So our banking system is what is the main source of external financing for banks and for households in Colombia. So it's very interesting to see that even though households and firms, most of them depend from credit extended by private banks in Colombia, the ratio of credit by banks to GDP is so low, is so shallow, this market. So it's interesting to study why. Well, bank net interest margins in Latin America and Colombia are high. So that's interesting. That's what many papers in this strand of research had found before us. And you can see that the bank interest margins in Colombia are above also those in Latin American countries, are way above those in lower middle income countries, and are almost comparable with those in low income countries. So that's kind of the question that we are studying here. Brazil will have a very similar graph for this same variable. Some people say, okay, banks in Colombia probably exhibit high overhead costs. So yes, that's basically what banks want to show when they show their balances and their profits at the end of the year. They want to say, okay, we earn good profits, but we charge high interest rates basically because we exhibit extremely high overhead costs. So it's true, banks in Colombia also exhibit high overhead costs, but even though overhead costs are relatively high to those of comparable countries in the world, the bank return on equity in Colombia is huge, is very high. It's almost double that in high income countries. So you say, okay, it's somehow you say, okay, credit markets are suffering from some source of scarce information. There's a lot of opaque debtors in the credit market in Colombia, high overhead costs, but still banks are very profitable in Colombia. So we want to study like a very basic question to see, does competition have something to do? My mother will say, for sure, and she's not an economist, and she doesn't work in the financial sector, but my mom will say, it's obvious. The problem is that competition in the financial system in Colombia is really low. But the question that we have in mind is, okay, in theory, the reduced first is, let me paraphrase better this thing. The first question we want to check is whether my mom's intuition is true or not. Yes, whether competition in Colombia is high or low, has increased or decreased, and have good measures of bank competition. And then go to the heart of the question of our interest, that is, does that level of bank competition affect the conditions in which firms are extended credit in Colombia? So that's the question that we want, the two questions that we want to answer in this presentation. So in this paper, we have, there are two main research questions. What has been the recent evolution of bank market power in Colombia? And well, you know that competition is mostly an unobservable variable, it's a latent variable. So different studies use different proxies of competition and different conclusions are obtained. So we want to build in work that have done other people on bank competition to try to refine the measures of banking competition for banks in Colombia. That's our first purpose of this work. But the second, that's the question that we're really interested in, is that does bank market power increase the cost of firm financing? And that's like the heart of our research. Well, to answer the questions, we have to construct bank-specific time-varying measures of bank market power. So this is an issue that has provoked like deep a profound debate when we present this paper. So we have presented this paper several times in different places, but when we have discussed this paper and the whole research project with professors from the US, we have discussed this paper, for instance, with professors from the MIT and other top universities in the US and in the world. They have one of the questions that they first ask is, why do you tell me that market power in an industrial sector like the banking sector should be measured with bank-specific and time-varying measures? Like, many of them have the intuition, especially for theorists, the intuition is that bank competition and competition in a market is more like part of the structure of the market. And that has been the focus that many economists, especially theorists, have put on competition for many years. So if you think, for example, in Cournot, when Cournot measures competition, he associates competition directly with a structuralist approach. How many banks do you have on the market, or how many, in another industrial sector, how many firms you have in the market? That will tell you how competitive is that market. So the idea that they have in their head is, if you have more competitors in a market, then the market will be more competitive, and then it will be more like a perfect competition paradigm. But this image of the more competitive banking sector, for more competitive banking sector based on the structuralist approach on a larger number of banks, has been recently debated by a more behavioralist approach. So if you take the behavioralist approach, basically is how do agents behave in the market? How do banks behave in the market? And if you recall the definition of perfect competition will tell you that if a perfect competition situation happens, it's because agents behave as price takers. That definition doesn't tell you anything about the number of competitors. You may have just 2 competitors in a market, but if they assume they are price takers, then they compete heavily in that market. And marginal costs matter, and then they try to be the more efficient they can be, and then they try to gain a larger share in the market, and then they behave more competitively in that market. So we follow that approach. For us, and following the latest literature, the literature from the 2015 onwards, that has basically shown that probably the structuralist approach empirically doesn't hold very much. We follow that approach and we stick to the definition of the behavioralist approach in economics, in which we want to proxy the competition of the market but the behavior of banks in that market. And I will build a little bit more in that idea later in this presentation. What do we do to answer the question? Well, we built a unique database that matches individual loans with firm and bank level data. And if you ask me what is like the most appealing part of our research, is really our database. Our database is a really beautiful database because we have information of loan by loan, every loan that a firm has obtained from a bank that works in Colombia, that operates in Colombia from 1994, but we started our information in 2004, I will tell you later on why, to the year 2014. So we have very fine information on interest rates. That's a great advantage of our database, and up to our knowledge, only 4 papers in the world have this kind of information for this kind of question. Ours, the one of the project in Mexico, the one of the project in Brazil, and the one of the project in Chile. And we basically have this information because we obtained agreements with the central bank of each of these countries to have that information and to use it with signing a lot of contracts that we can't share that information, and well, a lot of disclosure, but we have very fine information on loan by loan. So the papers that we have before ours basically study bank competition and use the price of credit, basically looking at balance sheet data from the firms. So they look basically at how much of the firms on average pay for their loans, yeah, but they don't have information on loan by loan. So that information they have is not really the most adequate to answer the question they want to ask. So we have a final measure based on this unique database that we have. What do we do with that database? Well, we estimate the effect of bank market power on loan level, individual interest rates, controlling for a lot of specific characteristics of a lot of fixed effects. So we include firm, bank, firm time, bank time specific, firm specific fixed effects to control for unobserved characteristics that are influencing the credit market all the time. So two main research questions are the ones we want to answer, as I've been telling you before. The first is, what has been the recent evolution of oh, I'm sorry, this I already told you. I'm sorry. So which are our basic findings? The first finding is regarding bank market power, and we find that bank market power was relatively high in 2004-2005, the period in which we start our research, and we say it's relatively high compared to international standards. Then it decreased importantly between 2006 and 2008, and then it started, and it was a period in which the competition in the banking sector increased or bank market power decreased, which are equivalent, even as concentration in the banking industry increased. So this is a very important point because it points out that probably measures of bank competition and measures of bank concentration probably are not directly comparable and are not really as related as many people, especially theorists, think they are. And this is not only a result of our paper, but of other papers that have studied similar problems have reached to a similar conclusion. And later on, from 2008 over, bank market power has increased. I'm sorry, there's a typo, it's not decreased, but has increased ever since. So in general, like the bank market power in Colombia has tended to increase over the last 15 years. Now, regarding the second question, the question between the relation between bank market power and the cost of credit, we find that higher bank market power seems to increase the cost of credit for firms, but the effect is small economically talking about. So basically that first conclusion is related with the third. Some evidence of capture then struck rents behavior. So up to our results, we have obtained that we have obtained up to the moment, we can find some evidence more in favor of the first hypothesis of the relation between bank market power and firm access to credit. More the rent extraction theory, the classical industrial organization theory of this relation between these two variables. Another very important thing we find is that misleading results will be obtained if you do not observe very finely for time-varying firm-level heterogeneity, for example, demand shocks. And this is a point that we have discussed with a lot of econometricians, for example, with Lars Hansen, who is a professor of econometrics at the Getulio Vargas Foundation in Brazil, a very fine econometrician. And we discussed if we should saturate our regressions with fixed effects, a lot of different fixed effects, or if we should try to control as best as we can with a lot of observable variables. And the conclusion, talking with him and other Thorsten Beck and other econometricians in the world, is that it's better to control plainly, very simple, but with a lot of fixed effects with firm, bank, time fixed effects and interactions between them in order to control very well for demand shocks. This is a very important point because as you will see later on, the question we try to respond may be accused or better, like the identification strategy that we used, some people may accuse that identification strategy of having problems of endogeneity. But one way in which we can respond to these worries about endogeneity is to control very finely for demand shocks, and you do it better saturating your regression with a lot of firms with fixed effects. So regarding a little related literature, there are regarding measuring competition, as I told you before, there's an old literature which measured bank competition like proxying it with concentration measures. And you can see that the advisor of our project, Professor Beck, was one of those authors that relied on concentration measures for measuring bank competition. But he changed of mind, fortunately. People have convinced him over time that it's better to use other ways of measuring competition that are more behavioral instead of structuralist. And we move in this paper together with the most recent literature on the topic, following the ideas of Boone in the Economic Journal in 2008, a paper in which he introduces the famous Boone indexes, and we move toward directly measuring a conduct in the market, behavior in the market as the best proxy for bank competition. Now, regarding the estimation of the effect of bank competition on firm finance, there's an old debate, the debate of the quiet life or the industrial organization hypothesis versus the information hypothesis, and there's many papers that have been very relevant in the literature. And there's a lot of papers recently that have tried to test those hypotheses, the competition of those hypotheses in credit markets. So I just mentioned here a few for those of you who are interested in going to the literature. But those papers have problems in trying to give an empirical answer to the question. And we have those studies on the effect of bank competition on firm finance do not have access to loan-by-loan information. They usually extract the average cost of bank credit using firm balance sheet data. And then, well, they had lots of measurement and identification issues. So our identification strategy is a little bit better than the ones that the papers had before. But it's not because we are very good in econometrics and we're better than people who wrote papers before. No, that's not the reason. It's because we have better access to better data. If those people would have had access to better data, they will probably have done the same identification strategy that we follow. And basically, our identification strategy is the following. We want to compare two otherwise identical loans, one provided with a bank with a given level of market power, and the other given by a bank with a higher level of market power. And our question is, do the interest rates on these two loans differ? If you have two identical loans, but one is extended with by a bank with more market power and the other one with a bank of less market power, and you observe difference in the interest rate charges to those identical two loans, then we have evidence that bank market power matters. And that's our identification strategy. So it's very transparent, it's very natural, and it's very simple to follow. Let me tell you some things about the financial system in Colombia. So in Colombia, we had a very deep, wide, economy-wide financial crisis in the late 1990s. And it was originated in a mortgage problem. So we observed in that crisis lots of bank runs, and very banks went to default. And the government had to basically to pick the financial sector up the pieces. It was the worst financial crisis that Colombia has had in all its history. And I guess it will be the worst financial crisis in all the Colombian history, also probably for the next 50 years. So I will tell you, this crisis of the coronavirus will not affect the banking sector and the financial system in Colombia as the 1998 crisis did. I had a paper I'm working on that topic. Then after that very deep financial crisis in Colombia, many regulatory responses from the government came. So first was a wave of privatization from 2000 to 2005. So basically in Colombia, in the financial sector of Colombia, there's only one public bank remaining, the Banco Agrario. That's a rural bank, and it's like very different from the rest of the banks included in the financial sector of Colombia. There's also a big wave of reforms in the 2005-2007 period. So there was the supervisory agency in Colombia, the Superfinanciera, that is the current supervisory agency, resulted from the merger of the securities and the banking supervision superintendents that prevailed before that time. And there's a law, the law of multi-banking in Colombia, that tend to move banks from specialized banking toward multi-purpose banks. So all those banks that specialized in mortgage credit that defaulted or that went into serious trouble during the financial crisis in Colombia of the late 1990s basically disappeared. They had to integrate with other banks, or they simply went out of the market. And in the integration of institutions to go to form multipurpose banks or universal banks, then a wave of mergers and acquisitions was experienced in Colombia, and that can explain basically the secular trend toward bank concentration that followed. So these two graphs are very illustrative. The graph in the panel, the left panel shows the Herfindahl-Hirschman index for the commercial loans and total loans in the banking sector in Colombia. And the right panel shows the market share of the top 3 banks in total assets, total loans, and commercial loans in Colombia. And you can observe a secular trend towards more concentration. So basically the history, the latest history of the banking sector in Colombia shows that the banking sector in Colombia has moved toward more concentration. And there was a peak, there was a huge change, a discontinuous change in concentration in 2005, and that was basically the introduction of this law to move banks towards multipurpose or universal banking rather than specialized banks. Now we move forward to the measures of bank market power in Colombia. So basically, we are introducing, or we are studying these 2 measures related with behavior of banks in the market rather than the structure of banks. And the first is the Lerner index. And the Lerner index basically measures the ability of an individual bank to charge a price above marginal cost, assuming both profit and cost efficiency. So you can recall from your classes of basic microeconomics that the Lerner indexes are basically equal to the reciprocal, the multiplicative reciprocal of the demand curve's price elasticity. So if you have a demand curve for bank loans that's very elastic, then the Lerner index is lower, but it's very inelastic, then the Lerner index is higher. So basically a higher Lerner index is showing more market power, and a lower Lerner index is showing less market power for that particular bank. But this here is for us, well, the price is the ratio of financial income, that's basically interest rate income, to total net loans from each bank at each point in time. Obtaining the marginal cost is quite a challenge, and we require first a measure of the total cost function, and I'm going to talk a little bit later in this presentation about how we do so. Well, but then in 2012, Keter and co-authors introduced the adjusted Lerner index. Recall that the Lerner index basically assumes that profit and cost efficiencies exist in the banking sector, but many papers have shown in the literature that this is not a true assumption, that basically, especially in developing countries like ours, like Colombia, there are a lot of cost and profit inefficiencies in the banking sector. So they introduced this measure that's called the adjusted Lerner index that tries to adjust for those inefficiencies. If someone has questions of the Lerner index or the adjusted Lerner index, etc., please write me to my email that Daniela will kindly provide you my email if you have any questions of anything in my presentation. But due to time concerns, I talk a lot, I'm sorry. I talk a lot and introduce a lot my presentation, so I have wasted a lot of, well, I have wasted, no, thank you. I hope it's not wasted, but I have spent a lot of time and I have to move a little bit faster to get to results. But if you have any question on the way in which I construct this index with my co-authors, please make it by email. I'll be more than happy to answer you. But then we move to the most accepted indicators of measuring market power in different markets in the latest years, and are the Boone indicators introduced by that economic journal paper of 2008 of Boone. And basically, the intuition behind the Boone indicators is that there is a negative relation between an individual's bank marginal cost and its profit or its market share. So basically, the idea is if you hold everything else constant, including the marginal cost of all other banks that are competing with you, and your marginal cost increases, that is that you became more ineffective, more inefficient in the market, then if the banking sector is very competitive, you will be swiped from that market. You will disappear from that market in perfect competition. If your marginal costs move a little bit above those of your competitors, you are swept from the market and then you disappear. So that's a very competitive market. So then that estimation beta, that's measuring the elasticity of profits to marginal costs of the bank in each point of time, will approximate minus infinity in the case I'm telling you of perfect competition. Now, on the other hand, if a bank has a lot of market power, because it's the only bank, say, or a very important bank for different firms in the market, and firms needed to put on their investment projects to make them feasible, then that bank is very important, and he can take the luxury to charge high costs to firms, because firms cannot escape from that high cost. So if their marginal costs increase, they can translate that high marginal cost to the benefit, and they will not lose market share nor profits in that case. So in that case, this elasticity will be very close to zero. So we want to estimate those betas, a beta for the benefit and a beta for the Boone market share index or coefficient. But then you will recall your basic econometrics course in panel data, in which they will tell you, okay, but if you want to estimate a beta that it's varying for every individual in your sample, and it's varying for every time period, you can't do that. So, José Eduardo, you are kidding me. You are telling me something stupid. José, I'm not stupid. And I know you are not stupid. You are very smart guys. The only stupid guy here is myself. So in order to estimate those betas that are varying over time and are changing individual to individual, we have to follow a estimation strategy different from, for example, ordinary least squares. So there are many ways of doing so, but it comes to my mind basically two different ways of doing it. One is with local polynomial regression over samples of varying sizes and starting and ending points of that vary. So that's the way in which, for example, in those recent papers of Diebold and Yilmaz that estimate spillovers, variance spillovers between markets, they used to do it. They basically do local polynomial regression over these samples that are varying in size and varying in the starting and ending period. But there's another elegant and easy way of estimating it, and is using the fixed effect panel coefficient model that was introduced by Professor Xiao from Southern California University in 2014 and has been used extensively in the related literature. So basically, what Xiao does is introducing in this regression that I'm showing you in the first and second of this slide, he introduces a bank fixed effect and a time fixed effect, and then he will run an OLS regression of with fixed effects of this dependent variable of interest with respect to the marginal cost, with a fixed beta for all time and for all banks, with an OLS beta, a beta, let's say like that, and he will obtain a beta corresponding to the bank and a beta corresponding to the point in time. And adding these three betas, you will obtain a beta that corresponds to each bank at each point in time. A very smart way of doing it that was introduced with Professor Xiao, and that we follow in this paper. And for those of you who want to do some kind of estimation like this one, and you are thinking of, okay, programming may be hard, I'll give you the good news that there's already a program in Stata, the XT Fixed COEF TVCU program in Stata, with which you can run this kind of regression and obtain time varying and individual varying betas, or in this case, elasticities of profits to marginal costs, or of market share to marginal costs, and it will be useful also for other papers. Okay, but the computation of all four measures that we introduce here for banking competition require the estimation of bank-specific marginal costs. How do we do so? We follow the literature and we estimate a multi-product total cost function using a parametric approach. You can do this parametrically or non-parametrically or semi-parametrically. We follow a parametric approach. And we follow the empirical banking literature. For example, Professor Tabak, who is one of the associated editors of the Journal of Banking and Finance, and what he does in his papers that he has published there, he estimates a translog cost function. What is a translog cost function? For those of you who are not related with this literature, not familiar with this literature, is a cost function which is a second-order Taylor series approximation to an unknown cost function. So it's very flexible in that sense. In the cost function that I'm showing you, that alpha sub beta is the bank fixed effect. We introduce Y1 BT represent loans, Y2 BT represents securities, W1 BT represents the labor unit cost or wage. That's the ratio of personal expenses to total assets of the bank at each point in time. W2 BT is the cost of funding for the bank. So it's basically interest rate expenses over deposits for that bank in each point in time. And WB3, it's a variable that is constructed at other expenses over fixed assets. So basically the W's are all the inputs used by the banks, and the Y's are all the outputs used by the banks. And probably if you are listening to me in this webinar and you are a professor or a practitioner in Europe or in the US, you will say, hey, banks have lots of other products more than simply extending loans and securities to the clients. So you are right. In developed countries, banks produce multi-product products, and loans differentiate one from another, and securities differentiate one from another. But in Colombia, basically, banks extend loans and buy securities from the government. So that's all what they have in the assets. The 90% of their assets represented by these two kinds of assets. So that's why we include only those two types of assets. D sub t, that it's a dummy variable that can take the value, that can take on the value 0, 1 at each point in time, and it's basically capturing aggregate shocks, so it's a time dummy. And we also include another variable that's bank equity, following a paper by Mestre in 1996. That variable is Z sub BT, and it reflects basically difference in risk attitude by banks. So there's a lot of literature. Helmati and other authors have worked in the hypothesis that when banks put more capital to their, where bankers put more capital, well, where the owners of the bank put more capital to their bank, then they put more skin in business, and then they want to behave more, they want to check that their managers of the bank behave more prudently. So basically, a difference in observed capital in banks could be a good proxy for difference in risk attitude taken by banks. Additionally, something important for estimation purposes is that we imposed homogeneity of degree 1 on input prices. That is an assumption that is commonly done in microeconomics, and that's done by dividing all factor prices and the total cost function of banks by W3. Sorry. Yeah. Then what we do is that we can compute our marginal cost function simply by taking the derivative of the cost function with respect to the loans extended by banks, and with the coefficients that we have there and with the variables that we observe, we can construct for each bank in time a particular marginal cost function that we are using at every point in time for the 4 indicators that we show. Here is a graph of the average of the Lerner index, the adjusted Lerner index, and the Boone indexes. So it's an average. So there's a lot of heterogeneity from bank to bank, but we present an average just in the paper, in the full paper. You can see these graphs for many banks, but for space here, I only present you the average. But you can see some regular patterns. All measures of bank markets powers suggest the same broad temporal patterns. So basically, you can observe that in 2005, 2006, the Lerner index, the Boone indexes are high with respect to the rest of the sample, and are high when you compare it to international standards. Even when you compare these competition measures, with our colleagues from Chile, from Brazil, from Mexico, from the US, from the UK, we find that our measures for the competition of banks in Colombia are less competitive, these banks within the Colombian financial system, than in other comparable financial systems, like, for example, Chile or Brazil. You can see then that there's a sharp reduction of market power in the period of 2006, 2007, beginning of 2008. And there's a question, why did this happen? And the answer is very plainly simple. Large capital inflows to Colombia and other emerging markets occurred largely in that period. Part of these inflows was through firm indebtedness with foreign banks. So basically, in that period of time, Colombian large firms gained a lot of access to credit, especially from the US banks and also from some European banks, from international banks. And then banks in Colombia, in order to not lose their clients, had to behave more competitively. That's a good illustration, for me, an excellent illustration on why competition is a problem of attitude in a market, of behavior in a market, rather than of the structure of the market itself, because the structure didn't change. What changed basically was the attitude of banks when they felt that firms were not demanding their loans because they had access to other sources of funding. Well, now we want to confirm our intuition that has been also confirmed by other papers in the literature, that the measures of bank competition and the measures of concentration are not like good proxies, are not proxies of the same latent or unobserved competition problem behind. And basically, we present in this slide a piecewise correlations between average market power and concentration measures. And you can see that the measures of competition, the Lerner index with the adjusted Lerner and the Boone indicator and the measured by the market share or the profit Boone, are positively and significantly correlated. But when you look at these indexes with the measures of concentration, you can observe that the measures are either zero correlation, like here, because it's not significant, or negative, even negative correlations here, and significant correlations, like here, like here. So what can we derive as a conclusion from this slide? That probably the measures of concentration that some people in the literature use as a proxy for competition are not good measures of banking competition. So I hope that some of my students that are making their master's thesis with me this semester and working on these problems listen to me here, because I tell them this thing once over and over again when I try these kinds of topics of competition and concentration in banking systems for the applied work. Now we go to our problem of most interest, that's relation between market power and the cost of firm finance. And basically, our data set, we construct, we find our loan level data from basically the credit registry was provided by the Central Bank of Colombia, but the credit registry is really obtained from the financial superintendents of Colombia. They are the supervisor of the financial system. The Central Bank of Colombia has this data. For example, Paola Morales, which is a Colombian economist that has been a co-author of my work in several papers and is working also with this database in the IMF. She also has access to this information from the Central Bank of Colombia, but the information is really from the superintendents of Colombia. And we gather information, I'm sorry, we have information over 1 million loans taken by more than 270,000 firms during the period 2004-2014. Why 2004-2014? Before 2004, the information for banks is not good information. So many people that have worked with this database tell us that there's a lot of mistakes and errors reporting in the database before 2004, so we exclude that data. And after 2014, exactly in 2014, when Colombia was trying to enter in the OECD fully, one of the commitments that the financial sector in Colombia did was to move towards a NIF, towards international way of reporting balance sheets from banks and other industries. And then the way in which banks reported the balance sheets to the financial superintendents of Colombia radically changed in 2014. So in order to have information for the largest possible period and to cover the episode of the global financial crisis of the subprime financial crisis of the developed countries in 2008, 2010, we used information from 2004 to 2014, in which information is comparable for the period in Colombia. Also, in that period, Colombia, that's a country that depends heavily on the price of oil and other commodities. It's a period in which oil prices grew, and there was not this all this madness of the oil market that's happening now. So we use the 2004-2014 period for all those reasons. Now, regarding firm level data, because the loan level data doesn't have information on the balance sheet of firms. We have information on the on banks, but we don't have information on firms, and we have information of loans from that first database, but we require information from firms for the ones that are acquiring those loans, for the debtors. So we gather information for 41,249 firms with balance sheet and income data from the antitrust authority. And we match with loan level data for 32,595 firms. So some firms were unable to match these two databases because sometimes we have problems with the information, how it's reported. Sometimes the identification variable of the firm is improperly written in one of the databases, so we couldn't match both. And we gather information from bank level data, balance sheet and income data, also from the superintendents of Colombia. The financial superintendents of Colombia is really wonderful. I have studied data of banks and from many countries during many years, and I can say that the information that the financial superintendents of Colombia has is first-rated information. It's the best I have dealt with. It's very organized. It's very transparent in the sense that they put the information in the web page. So I invite researchers abroad to get interest in our financial sector and explore the information that the financial superintendents of Colombia has in its web page. That's really wonderful. And people there are also wonderful. So they're always trying to help you get better information and work. It's a great superintendent. Well, from the loan and film level database, the merged database, we get information on different firms, and we want to a little bit characterize those firms, at least in the sectors to which they belong. And you can observe that at the beginning, the manufacturing industries were really representative of that pool of firms. But with over time, this sector started losing representation, and other sectors as trade, hotels and restaurants, the real estate sector, construction, have gained importance in the number of firms that are reporting information to the superintendents of firms from which we collect this information. Now let's go to our estimation strategy. So many of you may have in your mind an idea that we are dealing with panel data, and that's not true. Because our unit of measurement is not each firm, but is each loan. So for us, each loan is a different individual. So for example, Daniela she has a firm that produces potatoes. And she gets loans with different banks over time in different periods of time. Each one of the loans that Daniela is obtaining from different banks at each point in time is an individual in our sample. Yes, Daniela is not, nor her firm are not the individual. The individual is the loan. Obviously, some loans are more closely related than others. So the loans that are obtained by Daniela or by her firm are more similar than probably loans obtained by a different firm. We control for that basically using with the errors. We cluster the errors by firm in order to take into account that our errors can be contaminated by that fact. They are not exactly IID across every loan, but they are maybe more IID if we cluster for firms in our information set. Well, we have here the measure in which we are more interested. So we do a regression in which our dependent variable is the real interest rate. So we subtract the inflation in each period to the nominal interest rate that obtained by each of the loans that we have in our sample. And we regress this variable on our variables of interest that can be the proxies of competition, the Lerner, the adjusted Lerner of the bank, the Boone indicators of the bank. Also by a set of regressors of each loan. For example, if the loan has a guarantee or if it hasn't a guarantee, the qualification that the bank gave to the loan originally, the size of the loan, the duration of the loan, etc. We also control for characteristics of the firm. So for example, its profitability, its ownership characteristics, a lot of different characteristics, and also for characteristics of the bank that it's granting the loan. And our error is in an error that is loan by loan. We cluster errors by firm in order to isolate the problems that we have in the example I put with Daniela. So our main interest is in this parameter, in this psi, that's our parameter of interest. So I'm going to show only because due to time constraints here, they are telling me that I have talked a lot and I have to give space to the public to give opinions and ask questions. So basically, I'm going to show you only two regressions. The first regression is we regress the Lerner index of each bank at each point in time against the cost of credit of the firm. So what can we observe? Here, the dependent variable is the real cost of credit of each loan. Note that when we include few fixed effects, for example, only fixed effects, this and we control for loans covariates, banks covariates, and firms covariates, different sets of covariates for each individual. We obtain, we obtain that it appears that competition is like better or less competition, a less competitive bank, a bank with more bank market power is better for firms in the sense that they obtain a lower cost of credit given by these banks than otherwise they would have obtained with a more competitive bank. But notice something. As we start to impose another types of fixed effects, for example, time effects, bank fixed effects, and especially when we interact firm time fixed effects in this regression, that it's our best specification in the sense that we are controlling better for demand shocks that are happening in each period, that we cannot observe them, and that without these fixed effects, we will rather be ignoring the effect that they can generate in problems, for example, like endogeneity, that are severe problems because we will obtain biased and inconsistent estimates of our parameters of interest. It starts to become positive and very significant. So we love this result. But some of you may wonder, if you send all these results to a journal, maybe they will say, okay, well, why don't you stick with these results of negative and significant and not this? Show me only the result you want to show me. But I have always loved to be transparent in my life, in everything I do, in my work, in my daily life. I want to show all what I do, all the results I obtain when I do my things. And what we find is that when we exclude several fixed effects, we obtain a negative sign in this variable, but when we include them, we obtain a positive and significant, very significant positive sign of this variable. So I like more this result. Why I like it more? Because I feel more comfortable and more of the results are more robust in the sense that we are controlling better for factors that can bring trouble to our regression, for example, endogeneity, that are affecting for sure these types of results that we obtain here. And when we regress the adjusted Lerner index instead against the cost of credit, instead the Lerner index, we obtain a very similar result. However, there's a very important thing, is that notice that this coefficient and this coefficient are relatively low. But you can, someone that's wondering how do we measure the Lerner index and who related to an interest rate that is in the left-hand side of our regression, has a very good point. And how can we read the value of this coefficient? And you have to be careful because the Lerner index is measured in different units. It's not a percentage thing. It's measured in different units than our left-hand side variable. So what can you say? So what you can say here is that, or what I can tell you from my work and my results, is that a 1 standard deviation increase in the Lerner index, that is a 1 standard deviation reduction of competitiveness by that bank in the financial sector, leads basically to a 80 basis points increase in the real interest rate perceived by the firms that taking that loan. So let me tell you this again. Recall that in Colombia, approximately the real interest rates for the period we're studying for the loan, these types of loan granted from banks to firms is 15%, right? And our one standard deviation increase in bank market power, measured by the Lerner index, is basically represented in only 80 basis points. For example, passing from 15 to 15.8% real interest rate for a firm that took that loan. So even though the effect we're perceiving is statistically significant, is rather not as economically significant as we have expected. So now that I'm reaching the end of my presentation, I'm being very happy, but I think that you are hungry and are a little bit tired of me talking and talking a lot. I'm sorry for that. But I want to wrap up a little bit what I found and why I think is important and what extensions I'm trying to work on. And I motivate you to work with me or to work by yourselves or with other colleagues. You are free to do it about this important point of Colombia and other developing countries. Well, I'm not going to repeat the conclusion written here. You can read them, but I'm going to go rather to the extensions. A very interesting extension will be to do regressions by firm size and industry. And that will be very important because to include different firms in our sample. We have basically firms that report to the supervisory agency of firms, but we exclude here firms that are small firms, that are medium firms that have a low number of employees, and including those firms will be very important because, as you know, Colombia is a country in which informality and pymes, the small and medium-sized firms, are very representative of total employment. So our hypothesis, our educated guess, is that if we include those firms, the effect of bank competition, of changes in bank competition on the total cost of credit will be stronger economically than the one we're obtaining here. Our guess is that the sign will not change, the significance will not change, but the absolute value of the coefficient will in fact change, and that will be important for to understand better the impact of competition in firm access in Colombia. Another extension that will be very important to do is to include, and we're working on it, to include the bank lending relationship in the computation of the influence of bank competition on the cost of credit by firms. Why? If Daniela, in her example, she is very she has a close relationship with a bank in Colombia, let's say the Bancolombia, to say just a name of a bank, an important bank in Colombia, and they know, as we in the School of Economics and Administrative Science know that she's an excellent person, that she is very responsible, that she works hard, well, then Bancolombia will know that and will say, okay, Daniela, I can extend you a loan at better conditions than if I didn't know you, or if I know you and I knew that you were a bad repayer. So the bank lending relation, the bank-firm relation can matter here. And we're trying to introduce this bank lending relation into our regressions. And finally, another extension is try to define bank market power within geographical areas. I'm sorry, there's another typo here, but the thing is the following. In the US, it's very clear because in the US, there's a large number of large banks, but there are also many important regional banks. So in the US, there are like more than 10,000 banks, of which more than 9,000 banks are regional county type banks that extend credit to local businesses in the place they are located. In Colombia, it's not such because in Colombia we have 20-something banks that basically operate in different regions. But I have worked in a paper with a colleague of mine, Nidia Garcia, and with a colleague of mine that works in the World Bank, Xavi Giné, that it's one of the editors of the Journal of Development and Economics. And we have worked in some aspects of the banking Colombian sector and in banking inclusion, in financial inclusion. And we have found that when people go to their bank that's closer to the region, for example, if they go and ask a credit to a bank that they live in Tunja and they go to the bank in Tunja, they have a higher chance of obtaining the loan and in better conditions than if they go to the same bank in Bogota. So there's something of evidence that the geographical thing can matter, and we're trying to introduce doing georeferentiation of the firms in our sample and of the banks, or the branches of the banks, to do these same estimations with a geographical context in our minds. So that's all my presentation. Thank you again once more for listening to me, and I am looking forward to receive your questions and comments. Thank you, Dani.
Thank you for your presentation. you identify really important key factors of bank market powers measures for Colombia. So we're receiving a lot of questions. We will do our best for you to respond them. The first question comes from Professor Oscar Aldana. He wants to know how these high rates can affect the pass-through of the monetary policy from the central bank to the banks and then to the people.
Great question from Professor Oscar, who I know him very well. That's an excellent question and is something in which I encourage you to work on, Oscar. I have worked with, I published a paper very recently with Ali Kutan and Jair Ojeda, who are two colleagues of mine in these topics, and we have worked in the transmission of monetary policy, and we have seen that in Colombia, monetary policy transmission suffers or is subject to a lot of heterogeneity caused by different aspects of banks. But we basically test for the traditional bank lending channel, in which we introduce the size of the bank, we include the size of the bank, the capitalization of the bank, the liquidity of the bank. We haven't included this particular value of competition. That's a very important question. My intuition, Oscar. My intuition is that when you have banks that are less competitive, then you will observe a very strong heterogeneous response to periods in which the central bank produces contractionary monetary policy and when the bank is expanding its monetary policy. So let me build a little bit more in this question that is magnificent. It's a great question. When there's a situation in which the bank is expanding, the central bank is interested in the expansion of credit in the economy to motivate expansion of the economy, like in the moment we're living now, we are passing through now, then you can observe that banks with higher market power probably are not interested to translate that lower costs of financing to clients directly because they have higher market power. So they can have the advantage due to our result that the rent extraction hypothesis is the one that is most important in Colombia, most relevant. Then they can extract more of those rents from their clients. However, when there's a contractionary policy, then the opposite would happen. When the cost of funding from the banks increases, those banks with higher market power will translate those extra costs to their clients more rapidly than banks with less bank market power. That's my intuition, Oscar, but I invite you to work with me or with other colleagues if you prefer in that very interesting question that you are making. Thank you very much.
Okay, the second question comes from an anonymous professor, but he's asking, can you comment us about the different information sources in order to construct the database?
Sure. Well, I wasn't clear enough probably when I talked about them. Let me go back to this slide. Okay, our loan level data, we obtain them from a format that's called the format 341. So the Financial Superintendence of Colombia has a lot of special formats in which they collect important, sensible information from Colombian banks. The format 341, the Financial Superintendency collects the information from each loan extended by each bank in Colombia to firms, also to households, also one type of credit that's called microcredit in Colombia. They collect this information quarterly. So basically we have, for the period 2004-2014, all the information on all the loans extended to all the firms by all the banks in Colombia. So this is not a sample, but this is the universe of loans in Colombia, okay? Now, this transforms into a sample because we have to merge this database with other databases. That information, that database, I'm sorry, from the Financial Superintendency, the format 341, has only information on loan characteristics. For example, the guarantee of the loan, if it has full guarantee or it doesn't, if the guarantee is partial or not. It has information on the qualification of the rating that the bank gives to each one of the loan it extends at each moment of time. Has information of the size of the loan, has information on the duration of the loan, other information on other loan conditions, and you have the ID of the firms that are receiving the loan. So with that ID, you go to other database, and you have to obtain information from the balance sheet and the income data from each of the firms that are receiving these loans. And to do so, we obtain information from the Superintendencia de Sociedades. Excuse me to say the name in Spanish, but it's to make it clear, more clear to the person that is asking me that may be interested in working in this type of project. And the Superintendencia de Sociedades is the superintendency in Colombia that is in charge of collecting data from balance sheet and income data from each of the firms that have the obligation to report to the superintendency this information. Not all firms in Colombia are obligated to provide this information to the superintendency of firms. Only some firms that have some characteristics that are sufficiently large, that sell sufficient amount of products to the market, etc. So smaller firms do not appear in this database. And that's really unfortunate, because the question that we're addressing is most relevant for most vulnerable firms. So that's one of the things we're trying to extend down to obtain information of firms from Orbis and from other sources of information that's probably of less quality, that information, and probably with less frequency also. We can obtain that information, but we're interested in collecting it to test our hypothesis. And finally, we obtain also information from at the bank level, data information from balance sheet and income data from banks, from the Financial Supervisory of Colombia, directly from their web page. They are extremely transparent. They have information of every single balance sheet and income data from every single bank from 1990 to 2020. So it's excellent, the information. We use only from 2004 to 2014 because it's our period of study, but you can get beautiful information from the Financial Superintendency of Colombia. So thank you very much for your question.
So the next question is from Professor Amelie Blanc, and she's asking, Professor Gómez, with the COVID-19 and the Colombian government measures to help firms to access to bank loans during the crisis, what is your opinion of those measures taken by banks to face the crisis, and what will be the future effects in the bank market and competition levels?
Oh my God, what a great question, and what a difficult question to ask for me. So at this point of time, I should have said this way before, but I am making I'm telling you that the answer I'm going to provide you is my personal answer, and it does not like represent the point of view of my university, nor my dean, nor my colleagues, no, just mine, okay? Because this is a very, very hard and politically hard question to answer. So I think that the government of Colombia at this point of time has to do a little bit more in order to get loans to go to small firms and firms that are facing real trouble at this time of the COVID. So the government of Colombia, the Financial Superintendency has done a great work working with banks, and banks have done a great work in trying to maintain and extend loans to the firms that can do so. But you know that many small firms, for example, firms that are in services sector, firms that restaurants, how do you say this, where people go to dancing places, places to where people used to go as cinemas, etc. Many of them are going to be out of the market very soon, because even if the government decides to open fully the economy, it's hard that with this pandemic that's really dangerous for people, the risk of getting of contagion, people will return to these places and the demand will grow, and then they will grow exponentially, and then they will be saved. That's difficult in my mind to imagine. I think that many firms are going to make default, and basically because they are in some sectors that there's the way I think, it's almost impossible to save those sectors. So what the government can do in these cases is to extend credit not through commercial banks, but through the special purpose banks, what we call in Colombia, bancos de segundo piso, second floor banks. Those banks, bancos de fomento, those banks that are in charge of promoting some sector that may be in difficulty, for example, Bancoldex for the people firms who export, or for example, Finagro to firms that are in the campesinos, to small producers in the agrarian sector of Colombia. And to do this, my proposal is that the central bank buys directly from the government of Colombia bonds in the primary market. With that money, that's basically financing the government, and that the Central Bank of Colombia can do it. It only needs that the 7 members of the Board of Governors sign and agree to do it. With this money, the government of Colombia can capitalize these second floor banks, and these second floor banks can target credit better than commercial banks, because if I were a commercial bank at this point in time, well, I will be very careful of extending loans, because some firms probably are not good, are not credit worthy at this point of time. So I think that, wrapping up my answer, I think that the government is doing a good job, especially the financial superintendency has done a superb job during the crisis. But I think that the Central Bank of Colombia should do more, and that the government should direct the credit given by the central bank through second floor banks in order to get small firms that are still, that you can still save at this point in time, and that you can save the employment that's behind them, that it's of most of my worries and of everyone's worries and of the government's worries. You can save them, you can have these second floor banks extending credits to those firms. Thank you very much for your question. It's my personal opinion.
So just to wrap it up, I'm going to read this last question because I think it's really important. And as you mentioned it, I'm going to leave Professor José Eduardo's email in our chat in case you want to contact him to further discuss this topic. So the last question is, the result of the estimation models can be interpreted like causal effects?
Well, that's a very good point, and that's a question that microeconometricians and people working, for example, in development economics usually disagree with macroeconometricians or people like me that work more with financial markets and with these types of sort of data. So we are trying that indeed they are. Because the idea is, if you go here, we are trying to capture the effect of competition on the cost of credit that's perceived by firms, the interest rate, the real interest rate on a loan by loan, right? So we have kind of a quasi-experiment here because we try to control for different variables and for unobserved shocks, introducing lots of different fixed effects in order to answer the question and have a causal effect here. Maybe you are thinking in endogeneity issues that can arise here, and you can say, okay, you have in this left-hand side cost of credit, and somehow you have here also cost of credit, because in the price of the loan, you have the interest rate paid by these and other loans. Recall that this is the average Lerner index of the bank. So it's this and all other loans that he's extending, that the bank is extending, are measured here. So probably that source of endogeneity is not as important as at a first sight you might think. But in order to control better for other sources of endogeneity that come from, for example, things that demand shocks, basically, to group them in a package that may be happening at the same time and that will make this a correlation and not causality, we are introducing lots of firm effects that reduce those endogeneity problems. And my answer in short will be yes, I am confident that we are measuring causal effects here.
Okay, so thank you very much, José Eduardo, for your presentation.